If you're raising funding from an angel fund in the form of a convertible note, odds are the first thing they'll provide you, if they're interested, is a term sheet for the investment. It obviously helps if you understand what all those terms actually mean in the term sheet. So in today's video, I'll walk through line by line an actual convertible note term sheet and explain what those terms are. Hi, I'm Steve Morris, and I use this Startup SOS channel to provide practical how-to advice for new entrepreneurs who plan to build a growth company with investor funding. A term sheet for a convertible note is pretty close to a term sheet for a pre-money safe. The big difference is a pre-money safe has no maturity date and no interest rate, and one or two other minor differences. I'll point out the differences as we go along, but keep in mind, once you understand a convertible note term sheet, you're in good shape to understand a pre-money safe term sheet as well. There are quite a few terms that can be talked about in a term sheet for a convertible note, and here's a fairly sizable list. Not every one of these will necessarily be addressed in a term sheet that you'll see, but the vast majority of these terms will be addressed in the term sheet. We'll go through every one of them. Now, one other comment about the language in term sheets. I am reviewing an actual term sheet here. It's actually a combination of clauses from multiple term sheets so that we can cover all these potential terms. The term sheet that you receive will no doubt have different language. So certainly don't look for exactly the same language I'm using here in your term sheet, but the topics it will cover will be the same, and the essence of the understanding that you'll need is the same. So just be aware that your exact language, of course, will be different. Different lawyers write down essentially the same things with different words. So just be aware you'll have to interpret a bit the actual language that you get in your term sheet. So starting at the top, you'll of course have some language about who's the company, who's the investor, so it can refer simply to company and investor from there on out. But there's one other important thing it covers, is the fact that this is not a binding agreement. This is merely a document for discussion purposes. And in this particular term sheet, it of course states that the exact agreement will be incorporated into legal documents later. So it's very much not a legal document that's committing anybody to anything. It's for discussion purposes. Now, one possible exception, your term sheet might have a non-disclosure and no shop provision in it. In that case, it may carve out in this early on section an exception for that. This is that part is binding. We'll get back to that when we get to that part of the term sheet. One very important term, of course, is the amount that you'll be loaned. So just to make this simple, I plugged in an example of a $100,000 note. You may see this kind of boilerplate language that is essentially saying we'll put together legal documents, or the legal counsel for the investor will, to really formalize all this, and then it'll be a definitive agreement. But of course, this term sheet isn't a definitive agreement. A convertible note, being a loan, will always have a maturity date, the date on which the loan becomes due. So again, for purposes of example, I plugged in 24 months. So this is a 2-year maturity date on this convertible note. Yours could be, of course, less than that or more than that. And a convertible note must have an interest rate. And again, to keep it simple, I plugged in an 8% interest rate here. It's usually just stated as a simple interest rate based on a 365-day year. As I mentioned at the beginning, a pre-money safe is very similar to a convertible note, but you won't see the interest rate spec'd and you won't see the maturity date because a pre-money safe doesn't have either of those things. Now we get to one of the most critical terms in a convertible note. A convertible note is a loan, but it's a loan given with the intent that it's going to convert to stock. So this particular term defines what really is the desired, the hoped for way in which that conversion will happen, which is that there will be a later investment round that's a priced round where a value is placed on the company, which then puts a price on the stock, and investors invest in the company by purchasing stock. That is the kind of event that will convert the loan into stock if that later round qualifies as a qualified equity financing. What does that mean? Well, it's defined right here in the term sheet. If the company issues equity securities in a transaction, now, in other words, issuing equity means they're selling equity for a price, which means it's a priced round, as opposed to merely another convertible note round. So in the future, if they sell equity in the company and they get at least $500,000 in that round. Now, again, that's a number I just picked. It's a common enough number. Your number that triggers a conversion may well be different in a term sheet that you see. But that's the idea, is a qualified equity financing would be one that's a priced round that hits some minimal financing amount. That is what will trigger an automatic conversion of the loan into stock. And of course, it's the loan plus any accrued interest that will be converted into stock in the company. So now the only question is, at what price is that stock purchased? We're looking at a note here that has both a discount in the term sheet as well as a pre-money valuation cap. So the loan amount plus the interest is going to convert to stock at some price. That price will be the lower of two options: the price determined by the discount or the price determined by the pre-valuation cap. So first, they calculate the price based on the discount. They take a look at what was negotiated as a price by that later set of investors that did the priced round, and apply the discount that's specified in the note. That comes a little bit later in the term sheet. And that's one price they look at. The other price is then to take the cap and divide into that value the total number of shares in the company to get a price per share determined by the cap. And then the note investors get to choose the lower price, either the discounted price or the price determined by their pre-money cap. Now, if the pre-money cap is lower than the pre-valuation set for that later round, it's going to get a lower price than what was paid by those later investors. The trick is, it may or may not be lower than the discounted price. You have to calculate both to see which is the better deal. Whichever is better, that's what the note holder will go for. So that determines the price that they pay. And aside from that, they're getting all the same features and rights that those later investors are getting. They're just getting it at a lower price. Again, that assumes that there's both a discount and a pre-money cap specified in the convertible note term sheet. Of course, that means in the term sheet, you have to have the discount defined. So again, simple example here, we peg the discount at 20%, not at all an unusual number that you'll see in a convertible note term sheet. And of course, the pre-money valuation cap has to be defined. So again, for an example, here it's pegged at $4 million. And of course, your pre-money cap may be lower, may be higher. There's another possibility that you go to the maturity date of the convertible note, and that automatic conversion hasn't happened because there wasn't a qualified financing. You didn't do a priced round that hit whatever the threshold was, $500,000 in our example. And so the stock didn't convert as you got to the end of the maturity date when the note becomes due. Well, very commonly, there will be language for an optional conversion in that situation. And that allows the investor to, at their election, go ahead and convert their funding, their investment through the convertible note, plus along with their interest, into stock at some predetermined valuation. Now, in the example here, I picked $1 million. So they take $1 million, divide it by the total number of shares in the company. That comes up with the stock price, and that's what they would pay for the stock in converting their note into stock. You might think $1 million sounds like a pretty low pre-money valuation, and it is, but the idea here is you can see something that low because if you go to the maturity date in the loan, it may be because things aren't going well, right? The expectation was that the company would have a priced round that would convert the stock before the maturity date. It didn't happen. Things perhaps are not going well, and maybe the pre-money value should be fairly low. So you can see some pretty low pre-money values in this optional conversion. On the other hand, I've seen term sheets where it was set to the pre-money cap, which is typically a noticeably higher amount, in our example, $4 million. So again, it's all a matter of negotiation, and your term sheet will likely be different. Now, one other note about reaching the maturity date If the investor doesn't opt for this optional conversion, well, what happens? Well, there are really only two other alternatives they have. One is the note hits maturity date and it comes due and you need to pay it. The note gets called. Or the other is the investor might renegotiate, might extend the maturity date, might want to tweak the discount or the valuation cap as a result. But that is the other possibility, is just to do some renegotiation and set some new terms and maybe push that maturity date out a bit further. Another clause that you'll see could be titled something like change in control or corporate transaction payment. However it's worded, what it means is it's what happens if your company gets bought. And specifically, it gets bought before the convertible note converts into stock. So it's just a loan, and before the maturity date happens, your company gets bought. What happens to the note? How do investors get paid? Well, real commonly, you'll see, first of all, a clause that requires you to let the investor know, maybe a few days in advance, that this is happening. And then there'll be some kind of a clause that defines what you owe the investors. Now, very commonly, it'll be a clause like this, where it says you owe 2x of what was invested plus the interest, a 2x payment, in other words, a 2x return to the investors. Now, maybe it's 1.5x, maybe it's more than 2x, but that's a pretty common way to deal with the company getting bought. Now, sometimes you might see language that says, well, the stock's going to convert at some valuation, maybe it's the pre-money cap, and then it's merely stock in the company, and however the acquisition happens, the investors get their piece of that action. That approach is a little less common because sometimes an acquisition is structured in a bit of a complex way. Maybe there's an initial payment, and based on hitting some milestones, some additional payment, which might or might not be a good thing for the founders, but it's kind of an not necessarily a nice clean way for investors to get paid. So it's fairly common to simply simplify things and have the payment be just some multiple of the loan, as opposed to having the note convert to stock and be sort of a part of the acquisition. If the investor is making a fairly large investment in your company, they may ask for approval rights. This basically gives the investor a veto power. It's a great deal of power over your company, so it's something to negotiate carefully. But veto power over important actions the company might take. For example, a corporate transaction. In other words, if your company gets bought, the investor might want a veto over that if they don't like the terms. They might want to approve amendments to the company's articles of incorporation that they see as maybe not being in their best interests. That helps them protect their investment. They might want to approve certain types of insider transactions, especially including compensation to employees, because again, that might be a negative impact on their investment. And finally, they might want to have a veto power, approval rights, over payment of dividends and other types of distributions. They'd rather see the company's money, the money they invested, go toward building the company and creating a return for the investors, as opposed to paying dividends or paying other kinds of compensation. If the investor is investing quite a lot in your company, board observer rights is the other thing they may ask for. The right to have somebody sit in on all board meetings, participate in the discussion, not vote, but be a non-voting member of the board. And you may see this kind of language where they get to retain that observer seat even after their investment is converted into stock. Participation rights is a clause where they simply are asking for the right to continue to invest in the next investment round, let's say after their note converts into stock and later there's another round. Sometimes investors would like to have the right to reinvest to maintain their percentage of ownership. Otherwise, in each round, they'll get diluted. So you will sometimes see this kind of a participation right that ensures that they can indeed continue to invest. A very common clause is a most favored terms clause, where basically it's saying if you give better terms to some other convertible note investor after we invest, but before our investment has converted into stock, we have the right to change our terms to those terms. So for example, let's say you give another investor next month a better interest rate or a higher discount or a lower valuation cap, anything that looks better, more positive to the investor. They have the right to adapt those new terms. So it's a way for an investor who invested earlier to try to be sure that they have a fair deal and that later investors aren't getting a better deal than they are. A prepayment clause is something that you'll pretty much always see in a convertible note. Keep in mind that a convertible note investment is done not with the idea that you're going to pay the loan back, but with the idea that it's going to convert into stock and hopefully generate a very large return, much larger return than one would normally get from a loan. So the typical investor doesn't want you to pay back the convertible note. They're not in it just to get the interest you're going to pay. They're in it to get a big capital gain on the stock. So there will be a clause that essentially says, no, you can't pay off the loan. You can't prepay the loan. We want the loan to stay in place and eventually, hopefully, convert to stock. You'll often see this kind of standard boilerplate in a term sheet that essentially says, we can't amend this unless we both agree. If the investor is investing a fairly large amount, they may ask for information rights or specifically for reports. They may ask for, in particular, things like unaudited financial statements. They may also ask for access to reasonable information at reasonable hours, etc., so that they can get the information they need to watch out after their investment. One other clause you may see, although it's a lot more common, I think, in a priced round than in a convertible note, but is a confidentiality and no-shop agreement. This would basically say the company agrees to keep the term sheet confidential and not divulge it to anybody, except maybe to other people that want to participate in the round under the same terms. So you'll see this kind of language that says the company agrees that through the earlier of either 14 days from the date of the term sheet or until the date when the investor says, no, we're not going to invest, the company or directors or officers, etc., simply can't talk to anybody about an investment, about this note, about an acquisition, about any other kind of transaction. And so it's sort of an agreement that requires you to put on ice all these other discussions. It typically does not prevent you from talking to other investors who might want to participate in the same round under the same terms. And as I mentioned earlier, this may be the one part of the term sheet that early on is stated as being binding, unlike everything else in the term sheet. So something you might see in a convertible note term sheet. And finally, you might see a clause about expenses. This, again, is something that's much more common in a priced round, but I've seen it in convertible note arrangements also, where there's a statement that says each party will pay its own legal costs, if any are required in consummating this agreement, except that you, as the company, might have a commitment to pay, say, the first $2,500 or whatever the number is in the investor's expenses, legal expenses. Now, it typically will have a cap. It's not open-ended, but, and again, it's more common in a priced round, it's the company that has to pay some portion of the legal fees, and then the investor kicks in and pays the rest if it goes above some limit. Not super common in a convertible note, but you might see one. So that's it. Those are the most common terms that you will see in a convertible note term sheet. And I hope that helped you understand the basics and puts you in a better situation for understanding and negotiating any term sheet that you might receive in funding your company. If this was helpful, please click the like button and share it and leave a comment. And if you haven't subscribed yet, please do that and click that notification bell because there are always more videos on the way. That's a wrap for this time. Thank you very much for watching.